Today's questions come from a T-Mobile employee. What kind of tools do people use to lower their taxable income and thus reduce their tax burden? Donations strike me as a main way to essentially redirect tax dollars to causes that are worth it at a personal level. What are other things that people favor? Thanks for the questions. I love this topic. Charitable donations are now a less popular way to reduce taxes because of the Tax Cuts and Jobs Act of 2017. Three of the Act's biggest changes caused the shift. 1. It nearly doubled the standard deduction. Fewer people now have qualifying expenses higher than the standard deduction. 2. It capped the combined state, local, and sales tax deduction at $10,000. Those with high property and state taxes often lost tax deductions. 3. It limited mortgage interest deduction to $750,000 of principal balance. Homes purchased before the Act maintained the higher $1 million limit. With some expenses no longer qualifying and the standard deduction nearly doubling, more charitable donations are needed to reduce income tax. That resulted in a significant decrease in the percentage of tax filers with charitable contributions that actually lowered their taxes. The Nonpartisan Tax Policy Center estimates that the percent of returns with an itemized charitable deduction was cut by more than half, from 21% in 2017 to 9% in 2018. However, charitable donations still have their place. If someone has significantly appreciated holdings, it generally makes sense to donate them instead of donating cash. Not selling those appreciated assets reduces income, and the donation might qualify for a deduction. Also, bunching charitable contributions has become more popular. Instead of donating once a week or month, taxpayers may be ahead to make one big contribution every other year. With charitable deductions harder to get, it makes sense to look at other opportunities. Saving into pre-tax retirement accounts is the most common way to reduce taxes. These are the odd number plans like 401k, 403b, 457, which are named after where they are in the tax code. Contributions by employees reduce taxable income and grow tax deferred. The funds are taxed when they're withdrawn. The goal there is to pay a lower tax rate later than the employee would pay today. Many people earn more when they work than they will in retirement. In addition to lowering taxable income, these contributions are often matched by the employer. That's like free money. Another increasingly popular tax savings tool is the health savings account. HSA contributions are special because they're triple tax advantaged. Contributions are excluded from income in the year they're made, grow tax-free, and can be used tax-free for qualified medical expenses. That is, they might avoid taxes altogether. Here's a tip I picked up from the financial independence community. Someone can be reimbursed for qualifying medical expenses well after they're incurred. If someone can pay cash now for medical bills, they can keep the money invested in their health savings account and let it grow. Not taking money from the HSA is a bit like contributing to a Roth IRA, and there aren't any income limits. Someone with an HSA can save their medical receipts and submit them for reimbursement years or even decades later. The money can be accessed tax-free when it's needed. There's a drawback. To contribute to a health savings account, someone must be on a qualifying high-deductible healthcare plan. That's just what it sounds like. If someone has significant medical expenses, they're going to have to pay more until the high deductible is met. Don't let the tax tail wag the healthcare dog. A third, though often overlooked way to reduce taxes is with a spousal individual retirement account. Let's say someone works full-time. Their spouse manages the household and takes care of the children. The stay-at-home parent will likely be able to contribute to a traditional individual retirement account. They don't actually need to earn any money to contribute as long as their spouse has enough income to cover them both. Aren't tax deductions on IRAs subject to income limits? They are. However, those limits apply to people who participate in a retirement plan. A spouse who has no earned income probably won't be covered by a retirement plan. Tax loss harvesting is a fourth opportunity. Investment losses up to $3,000 may reduce taxable income for the year. If someone has assets which have fallen in value throughout the year, they may be able to sell them for a tax benefit. There are many limitations. These losses can't be in retirement accounts. Also, the same investment can be purchased within 30 days before or after the sale, which can get tricky with equity compensation. Certain types of losses, such as passive investments, might not apply. It's also important to note that these are net taxable losses. Tax loss harvesting likely won't work as expected if someone realizes more gains than losses on investment sales for the year. A fifth option is to specify what's sold. Investments held at least a year and a day are generally taxed at a lower rate than if they're held a year or less. Many custodians default to selling the last shares purchased. Ouch. Instead, specifying the shares to sell can help lower taxes. There are exceptions to every guideline. For instance, equity compensation tax treatment is all over the board. Taxes may be lower if someone sells restricted stock units as soon as they vest. On the other hand, stock bought through an employee stock purchase plan may need to be held 18 months or longer to qualify for the lower long-term capital gains rates. This video barely scratches the surface of how to reduce taxes. Minimizing lifetime taxes is a crucial part of financial planning. For more content, subscribe to the Scale Finance YouTube channel or check out the Insights page on scalefinance.com. Thanks for watching.